So let's take a look now what's coming up. So this is on the horizon. These are the trades coming up in October. Now, currently, right now, you can see the choices and things that you can start putting on your watch list to monitor. Some might be the ones you like to follow. Others might be things that you've never traded, you don't have any interest in. But here's an example of crude. So this would be a long crude oil trade. It tends to go into seasonally on the 4th of October and out, 13th. So kind of a short trade. Now this has been a winning trade 12 out of 15 years, so 80%. And then you see that the average profit per trade has been 1,026. So with this coming up, I would just be, again, looking at, I've used the trading model and be looking for these dates. Now, if the market momentum is down coming into the 4th, I'm not going to do anything. But if it's starting to turn back up, then that's a trade that we can look at. So if I just, for example, I know this one isn't as high a probability, but it's still not bad. 12 out of 15 years. So I'll be watching this one just with the trading model here, monitoring it as we get into October. So here you can see we're down, pulling back here right at that 85 level, not showing any signs of kind of flattening out or momentum starting to shift. But once we do see this shifting, and if it's shifting in that time frame of early October, then that can give you a good alignment to, okay, let's take a shot with going long crude, something like that. And you could use USO as well, or options. Okay, so then I come down here and look at this one right here. This is a big one. This is natural gas. So you can see it goes short March natural gas contract every year, like around the 12th of October, and then out the 10th of the 24th. So this has been a winning trade 15 out of 15 years. And the average profit per trade has been $1,582. So then we can drill down more into those statistics. If I want to look at it, oh, wow, that looks interesting. Let's take a look. So we'll look at that. Now, here's some other stuff. Here's euro dollar, 14 out of 15 years. Here's the soybeans. Soybeans are really good ones too. Here's 14 out of 15 years here. So just a lot of things to look at and choose from. Some may be ones you're interested in, others may not have any interest in. Here's December, the Dow. So you could do the diamond, you could do the Dow Jones futures. So it gets in around the 10th and out the November 10th, 87% probability, 13 out of the last 15 years, $2,480. This will be one to definitely keep an eye on right here. So I'll be watching that. So then what I do is I take the ones that I'm interested in and I make my own watch list. Okay, so this one would be one that I want to watch, the Dow. I want to watch this one here. Those two, one has 15 out of 15. This was 13 out of 15. Not bad. We can definitely time that one with the model really well. Probably maybe look at decent soybeans because those are really liquid. So maybe crude oil. So I would have these on my watch list, and then I just kind of monitor those each day. So I'm going to know when these entry points are going to be, but then I'm going to use my trading model to enter it. Maybe sometimes it might enter a little bit earlier or maybe later, which gives you a better entry than the seasonal dates. So if we drill down into that natural gas contract in March, again, this is selling, going short natural gas. So you can see that the stats here, here's this year, it's coming up. So entry will be October. Here it was last year. So this was the October the 21st. So this was October 21st, and then it was out October 12th, excuse me, then out the 12th, right there, the 22nd. So this was 10, 12, 21. Let's put that in, and then out. And this had a profit of $3,240. Now, out of these trades, the average profit per trade, if you'd done this religiously, was at $1,582. So 100% reliability on that trade, just some seasonality. So it gives you, just makes trading easier. You don't have to be just totally thinking, okay, man, the S&P is down hard today, up yesterday, etc. But if you have these kind of things to look forward to down the road on the horizon, then you can be more focused on these types of trades, which tend to turn into pretty good trades. So here's the seasonality statistics on March natural gas. You can see how dramatic this is. So here it is, pretty much where it tops out there, in October. So this is shorting this contract. Look at hard down. Now this natural gas just pretty much gets obliterated until you get towards the end of January. So that's when they're starting to put together, start restocking the natural gas flows, inventories. So that's a look there. Okay, and then if we look here at, just go back here, I'll pull up natural gas, and you can see last year what it did. And this got in the, let me get the dates again here so you can see. So these were, the dates were going short around the 10-12 short, and then out 10-22. So some of these trades are not long, some are real long. And then I just follow the momentum and stick with the trade if you want. So here's just, we'll put up natural gas real quick, and you just kind of see last year what it did. So here's natural gas. So let's go back here. Last year. So the entry on the seasonal was right on the 12th. I'll just put that in right here. And then it got out the 22nd. So I'm going to mark this trade. I'll show you what the system would have done. So the seasonal entry was right here on the 12th of October, right there, right here, short, okay, went short, okay, then had a little bit of retracement back up, came back off, got out of the trade the 22nd, which was right here. See, fairly short-term trade right there. So shorted here, out here, and this made, well, we'll go back and look. So looking at the trading model, that's pretty in line with what the seasonality trend was. So I would be using another time frame with it, but just from the daily, you can see that this probably, momentum was down. So it was in alignment with our momentum indicator. So this definitely would have been a trade that you would have looked to take based on that seasonal statistics. And then you can see it start shifting up. We had a cycle reversal here, so it's perfectly in alignment there on that exit. So it would have been out right there. So not, again, confirms that trade. And that trade, would have made, this would have made this last year, that if you did that trade, it made $1,370 per contract. So that's a look there. Well, that's a good point. You would think that natural gas would have more of a floor, and I agree with you. But right now, look what natural gas is doing. There's certain things that natural gas is really kind of moved down. It's just really sideways, so it could shift. But right now, and this is October, so I would just be watching it. It may get to October though, and maybe it's not down. It could be up, so then you wouldn't take the trade. So that's a good point though, because the fundamentals, with the European situation, that should put a little bit more of a floor to natural gas than we've had in the past. So yeah, I agree with you on that. So that's why I like to use the cycle model, because let's say the seasonal trend shows you, okay, get short October, but if we see our momentum is up, then I'm not gonna take that seasonal trade. So that's the beauty of having the combination. So let's say that, for an example, what if, let's say the seasonal trend went short, would go short on this date here, so July the 4th or 5th. Now that's seasonal, right? But if I see my momentum indicators are up, I'm not going to take that short. It was probably actually maybe had a long. If you look back, this probably went long. Okay. So here's that continuation pattern, pretty ugly.